Happy New Year, Alpha Capital Group. It's Planter here again, and I'm going to give you a little bit of an update on where I think we are going into 2024 and a little preview of events this week and a quick look back at last week and maybe a little bit of charting at the end. So let's crack on. 2024 in itself, the outlook, where is consensus? Consensus is a bit of a sort of hide behind everything kind of idea. As you've probably seen in the press, they're usually wrong, and spectacularly so last year. I think there's a really good stuff by John Authors, used to be FT and on Bloomberg. He does a hindsight capital, and every year it seems that people just are so far away from what's really about to happen. And if you read a lot of these consensus views from the market, there seems to be this obsession with not being away from the peer group, relative outperformance paralysis, we call it. Everyone's scared to be away from the mean, so we don't really get a lot of insightful stuff, but it is quite instructive to know where we are. The market itself, the charts tell you where the consensus really is, but we need to know what's driving people's ideas, what creating the buyers and sellers. Obviously, last week, it was a classic case with China. You know, they came out with the first bit of decent data for ages, but that rally into the end of the year kind of put paid to any reaction. And that's often what we call traveling and arriving. The market's already factored everything in. Let's have a little discussion going forward here about what we think is in the markets. So Christmas, I managed to read a few little things in between finally getting to sit down and do the Barbieheimer. I wish I'd have watched them the other way around. I watched Oppenheimer first, and that was brilliant, followed by Barbie. WTF. That made me want to watch Oppenheimer again. So in the meantime, what actually was the net of reading a few notes, and luckily some people out there had summed it up quite well. The default option is that interest rates are going to kick in. Most central banks, they sat on the laurels saying how great they've been, but they may well have overcooked it a little bit. So at best, people are hoping for a gentle slowdown and hopefully a Q2 rebound to the markets. That for indices means stocks are positive but underwhelming. You know, the likelihood is that there's a recession or this soft landing everyone keeps talking about. This is not necessarily what's going to happen. Bonds are being pushed again for the chance that if interest rates are coming off, you'll get capital growth and you're starting off with a decent yield. So it looks a good place to hide. Consensus is runaway inflation is defeated. So we've still got inflation in the system, but are we going to get any crazy prints? Well, a lot of that depends on geopolitics, probably. Business cycle, really mixed ideas. Again, is it a recession, soft landing, hard landing, to be or not to be a recession? US politics, absolutely mad. Who can call that? And it sounds like the market doesn't really have an idea, and they're going to get more and more nervous as we go through the year. Perhaps another reason to expect a bit of a consolidation or sell-off. More of that later. We talked about real rates before Christmas, and the consensus again says that they're going to be stubbornly high into half two. That means if they don't start cutting interest rates quickly, it's going to have a pushback on the economy. And we're left with inflation misses to the upside. But how can that be? I thought we'd said up above that runaway inflation was defeated. The problem is when you've got a weaker dollar, and we seem to be stuck in that, we'll look at a chart later, that makes imports more expensive. That could ripple through to some of the inflation prints, and that creates this feedback loop where they don't cut rates because there's inflation, blah, blah, blah. But we'll have to see about that. So we know, and we've already said, that the consensus, the muddling crew, don't really want to say anything at all. So there must be someone out there that's got something different to say. Unfortunately, they're all a little bit on the bearish side. Those outlooks, as I said here, skewed to the downside. And they're quoting, they don't believe that the consensus earnings for the S&P, etc., are in the realms of reality. They see a hard landing. I mentioned that earlier. That's a little bit out there, but potentially the central banks have done too much, and that they're actually going to, even though we don't see it in the numbers now, later in the year we'll see the economy and then the markets blowing up. But, you know, despite the fact central bankers generally are bad at forecasting, and they will be behind the curve on the way up when they had to change interest rates, they sat there quite smugly at the moment. They don't think they've over-tightened. They're on point. The economy's sorting itself out. The market's done the interest rate pricing for them. So they bought themselves time. And at the moment, interest rates likely to change sometime between March and May. But there's always someone who comes out and tries to kibosh it, and there she is, Janet Yellen, over the weekend. The glorious fence sitter herself has come out and declared that's what a soft landing looks like. So that can only go wrong. So we might as well put a line through anybody that said soft landing. Of those out there, what looks the most sensible for all this confusion is the BCA strategists. They're saying that in all probability, you probably still get a half to 24 recession. Remember that inverted yield curve, it's never not had a recession. So that could still come and be a curveball for the market. And they're saying just as things look super rosy and everyone's expected and said that a recession or soft landing can't happen, recession can't happen and a soft landing's baked in, this will come and bite us in the bum. So as far as what I can see, having looked at charts, etc., and suggesting some slightly different things, the only thing that no one's really talking about is a continuing breakout for the stock markets and the fact that gold's actually in the latter stages of a long-term bull market. Everyone's talking that down and it's the end of the gold rush, etc. But more on that later. So this is where things get interesting, this part of 2024, because it is put up or shut up time. We're going to look at a chart in a minute, which is central to a lot of the arguments, even amongst the sort of wave theorists out there. There's a real two-way pull. So it's obvious we're near a top of some sort at the moment, short term. But is that going to lead to BTDS? What the hell is that? Buy the dip scheme. You've probably heard that over the last few years. And that's when every pullback was seemingly sucked up by the market and we just pushed up again. A lot of that was the POMO money, basically the bailout money from the Fed buying bonds and the money getting reinvested. But despite that there's still potential for that to happen. Why? Well, in the first instance, we're in a presidential year. A lot of the movements in a presidential year happen in the first quarter. The year before is always a strong year, and that, if we'd have been talking about this last year, that would have been one of the major factors. The third year of a US presidential cycle is generally positive, and then you get another little surge at the start of the actual election year, and then after that, it's a bit of an impasse because it's hot. It's all back to the debates, and there's very little policy going on. So in terms of the bull market we've had since October 22 lows, it looks pretty much like we're in a very mature stage of that. So if that's the case, we're going to have a top pretty soon, and then you'll have a three-wave pullback. Now, I've alluded to this already, but whether you're bullish or bearish, you're expecting that pullback at the moment. So even though it looks like we might have a small amount of upside left short term, there is going to be a pullback, whether you think it's going to carry on later or not, and I'll show you that on the next slide. But most of it depends on how you interpreted the end of 21, early 22 top for the market in general terms. So let's look at that chart. It's the S&P 500. If you're talking about in terms of long-term decade moves, the debate is whether the pre-COVID high or the high we saw at the end of 2021 was the all-time high. Now, the reasons given by the people who believe going into COVID was that it was high, is that you got a 34% pullback in the market. Well, obviously the quantum of that is pretty important, but it only happened over 5 weeks relative to something we're talking about has happened over years. It doesn't sit well, particularly, and yet there was an expectation this was an important fourth wave, and that there was a final fifth wave of the biggest cycle, one of the biggest cycles, the super cycle as they call it, to put in the eventual all-time high. Now, the problem with the people who've been looking for that is that they've tended to be super bearish over time. So there is a real pull here. So the people who you consider quite bullish were here, and the super bears are here waiting for it all to collapse. So whether the debate is this pullback here part of a big three-wave move from an all-time high before the market eventually shoots up, or was this the significant bottom that we've started again from? So this was into 2021, 22 end, was the first leg up. We've since consolidated to that October the 22nd low, and then what we've been doing last year is the first stage of the new bull market. So The choice is we're going to have a small consolidation here and we shoot on up, which hardly anyone in the market is talking about, particularly at the minute. But it's very easy to construct this super bearish argument. There's so many things at extremes that we're up against highs, hasn't necessarily broken out, and that it's all going to get very negative. And that's going to actually, it sounds like it's big picture, but that will have to frame how we deal with the market. We look at it generally as traders in the short term, but it's going to make a big difference to what you believe your stop losses are. And if that does turn out to be a negative year, these things are going to accelerate very quickly and you'll be catching the falling knife, as it were. So we really do need to have a sense of what kind of market we're in this year. So for now, at least, everybody seems to be on the same page. Both camps in the short term are looking for the potential of a little bit more of a breakout. We'll look at that later. And then the meaningful sell-off could even start in Q2, and that might be factored around what the dollar's doing, and we're going to look at that in a moment. Now, in the weekend chatter, Goldman Sachs was saying that earnings consensus is too low and that it's highly likely that in the weeks ahead, as Q1 earnings come out, it's going to get beaten. So that could be the kicker we need to have this next push higher. But whatever, we're going to look at riding these waves, and we need to know where the turns are. That will be the feature of a lot of the charting that I'm going to show you in the weeks ahead. The idea is to map the turns. That's where the real profits are to be made. We'll need to zoom in the short term to see where we are in those setups. But because the nature of expecting a sell-off, the golden ratio, which some of you will have heard of, 1.618, is going to become very important, because when you set up a bearish three wave, and you have a secondary stop which is 1.618, because if the markets push on to that level and beyond, then you're in an impulse, and the setup is actually going to carry on going the way that it has been. The trend, and you'll be fighting against the trend. So that is about to become quite useful. And I know a lot of people have played Fibonacci and they give up on it because they try and use it as a tool that works every time, but it has a number of uses. It's not just all about the actual profits you're trying to make and the expected range. And I love the golden ratio. If you actually divide one by you make the inverse of the golden ratio, one divided by it, it gives you 0.618. And if you divide 1 by 0.618, you get the golden ratio. So it's this lovely full square in a circle within Fibonacci. And I'm going to talk about Fibonacci a lot, and I'll do a little series on it. So I think it's a beautiful tool that seems to happen and occur such a lot in the markets. So what about my favorite, the dollar? As I've said quite a lot recently, the inverse of the dollar to risk assets continues. We're in a consolidation phase, which is nearly at an end, but we're within the last 5 wave moves down. It depends what degree you're looking at, and we'll do that later. But for Q1, it still looks like we're net in a sell-off phase, and by default, until something changes, the Bank of England, the Bank of Japan with their potential rate rise, all the non-US dollars currencies showing strength, then that's going to stay as the consensual play. But this has not always been the case, and you can have a situation where the dollar goes up and so do risk assets. And there's a theory that you'll hear a lot spoken about, I think, over this year. I've already heard it mentioned over the Christmas period. The dollar smile. Stephen Jen of Morgan Stanley fame, way back in the 90s, I think it was, came up with this. And that by default, the US eventually comes out of a recession or the excess interest rate situation where it's had false strength, as it were, to be the dominant economy for a period. And that means that all the flows coming in are actually positive, as opposed to being flying in there as a flight to quality. And this is something that potentially is going to happen, because we are due the bounce in the dollar once this phase finishes. And is it automatic that that's going to be a negative for the markets? That could be the curveball that we're waiting to play out this year. And when it comes to the sentiment on the euro, which obviously is by definition the euro dollar is the opposite trend. It's the same trend, but it's the opposite way around. That the positioning in that has got a net short exposure to it. There's very little skew beyond 3 months of a positive varieties. That basically means everyone's either short or neutral. So anything changes in the market, there'll be a real scramble to get those euro shorts back in, and that's probably something that will help this next dollar sell-off. But after that, that's when the dollar smile may be looking down upon us. Remember, though, that in the last few years, 2 or 3 years, we've had big trend changes in risk assets around the start of the year, and that has obviously had an effect on Forex. So if you're looking for there to be a trend change, it's likely to come this month. And as we've discussed, there's a good chance that the dollar's very close to a bottoming out. That could come by the end of January. But outside that, Q1's really all about central banks. And can we find out who cuts rates first? Who does it most aggressively? The market at the moment seems to think it's the US, and the flip-flop we had over the data on Friday showed you how volatile that is, where we went from something like a 60% chance of it being the first cut being in March, all the way out to not happening at all, back to being 70% chance post that ISM print. So it's all absolutely all over the place. The Bank of England default is June, and the ECB is probably posturing to be in last place, but the data might not allow them to do that. So we can see the Fed's still facing the battle over their 3 versus the 5 or 6 for the market. The Bank of England, Bloomberg, are beginning to give an idea that things might be easier, quicker than what people think. So there's chance rate cuts do come, despite what all the Bank of England spokespeople say. And if anything, the start of this year has seen the ECB interest rate cuts pushed back more than anything. Is that going to be the default case? We're yet to find out. So I'm focusing a lot on the US economy and associated things, but that's right. And generally, they are the driver of the world economy. Are there any upsides or downsides to this muddling along idea that we presented so far? The US GDP has been running quite well, hasn't it? 5-6% range, and the inflation figures, whether it's PCE or the CPI, somewhere between 3 and 4. So that gives you that real 2%. Take off the inflation from the growth. The risk this year is heightened because you've got potential fiscal drag. So what does that mean? That means that the government spending is going to be very limited. The deficit's doubled. There's been lots of moaning. Remember, we talked about the credit agencies. And then we're in the US presidential year, so nothing will get done. There's an impasse between the two houses. Nothing's getting voted in or out, and it doesn't normally happen in the voting year anyway. The other side of the coin is their upside. We're running just above 200,000 claims per week for the initial claims and continuing claims. Could that accelerate down? Things going for the Goldilocks and above? There's no landing. The economy just actually carries on going as it is. This is deemed as being the unlikely, the outsider. Everything carries on. Few inflation worries. We're in a golden period. I would say that's back to normal. If you spoke 2 years ago and said that having spent the best part of 12 years throwing money at the economy left, right and centre to get no inflation, and then 2 years later we'd have this breakout of inflation alongside growth, everyone would throw you in the funny farm. It's just absolutely ridiculous. But before all this happened, before the GFC, analysts quite happy to see interest rates at 4% and real rates at around 1%. That was absolutely brilliant because you can actually get a little bit of spending power into businesses and everyone's happy. So, as I said earlier, it's an outlier, but this is the one thing people aren't focusing on, and it could really quite easily materialize. So what about oil? Black gold, as it were. This is a double-edged sword, really, because it's obviously been the major problem in the energy crisis. But now, is it showing something quite dangerous the other way? Is the lack of demand something that's going to derail the markets? But equally, if you've got lack of inflation from oil and lack of activity, then you're going to have the interest rates flying off. So it's a tricky one. But anyway, oil itself, it's in a bit of a shocker, isn't it? Look at the chart in behind from that May 22 high. We've had a 5-wave move down here, and it looks pretty much like we're going to do what they call the zigzags, so the equal legs we talked about earlier, regardless of what's happening here. So, we've had some geopolitical risks which gives the chances of doing a double consolidation, but it's already done enough as a pullback to suggest that it could go all the way down straight away, of which we've had the first move. Either way, it looks like we're heading for this range, $50 to $40. Demand is so low that inventories have built up. Saudi Arabia over the weekend have thrown a $1.50 slash to their inventories. Put that through your sausage machine. That's surely going to help the inflation figures as we carry on through the year. And if we're not careful, oil is starting to look like a one-way bet. So be very careful buying the dips in that one. So gold, we are in a long-term bull market. I keep going on about this, and we'll look at the charts again. But there's such a lot of volatility, and the ranges are really, really wide at the moment, which is why we have to be careful. And it might seem impossible to call what's happening. So it's driven by falling yields and interest rates, prima facie, particularly the other way around. When interest rates are 4% and above, gold really struggles, and we saw that last year. But there's some real driving factors in the background, which is why we're probably going to have a breakout pretty soon. Sovereign wealth and central banks have gone back into buying mode and have been doing over the majority of 2023. There's lots of geopolitical risk around. That's an obvious beneficiary, but not the real driver. Outside that, real fundamental factors, the super cycle. This is when there's a real melt up in mining minerals and assets, and normally driven by the fact that there's been a shortage of investment in new mines, etc., and demand exceeds supply, and that's particularly the case in gold. There's a massive shortage of both producing mines and large finds, large supplies of gold in the ground to be taken out. There hasn't been a large one for quite a while. So the long-term chart in itself is in a fifth wave and incomplete. I'm expecting a breakout to new highs once it settles down, and we'll look at that chart later. And back on the plate is the chatter about its lack of inflation protection. But if you look at it, its inflation adjusted high in the 80s was above $3,000, and there's every reason to believe that could be the ultimate stopping place for gold. And it's started to be discussed again. Jim Reed at Deutsche Bank started chattering around Christmas about this. He's normally quite a shrewd operator, so don't rule it out. But there's certainly a concerted move above 2,000 coming, and we'll look at that soon. Anything else globally to keep a watch out for? Well, China, I said at the start, came out with some data, but there was no index follow through, and President Xi was quite surprisingly downbeat, admitting mistakes. They never do that, and apologising for businesses going bust, etc., etc. So probably no reason to expect them to pull back on doing a rate cut, and it's highly likely there's going to have to be some more stimulus for the collapsing property market. They are the most likely area to start stimulating again. Politics, it's all over the news, but a huge proportion of the planet is voting this year, and that's whether it's a free vote or not. Particularly India, UK, and the US may see regime changes, and the most distinct and potentially market-moving one is happening this Saturday, which is Taiwan. And they have two candidates slightly opposed. They've got a proper choice for one. Do they remain strictly independent with the incumbents, or do they vote for the chap who's suggesting that they look for the safe option and start working with China more closely? So that will obviously be watched next weekend. We've also got the geopolitics, touched on it slightly in the oil discussion. Iran seems to be desperate to coax America into a proper fight, and the recent bombing at the weekend will only bring that to the forefront. And Houthi, US jumped in straight away to try and sort that out on the seas. We can't have the global economy held ransom to the pirates, etc. So there's a risk that this escalates. There might be a renewed bottleneck in the supply chain. That's obvious. Impacts for higher inflation again, one to watch out for, but it looks like the US are on the front foot. Outside that, now, there's been a number of questions asked about why Powell and the Fed would only want to go for 3 rate cuts, and the market is going for 5 or 6, and why delay it, blah blah blah. But they've got a dual role at the moment. They're trying to wind in the QE, the QT program, the quantitative tightening, and as you can see from the chart, that they've actually been quite active doing that. And they've, in the last FOMC minutes, it was slightly discussed by some people, but they're trying to make time to have a conversation about what the impact has been. So there's every chance that they might not cut rates, but they stop the QT. So that makes the overall situation more liquid. When you've got high liquidity, the markets rally. So they're playing a fine balancing game, and that might be a tool they use as an excuse to delay the rate cuts and yet not derail the economy nor the markets at the same time. So another one to watch out for there. And now, what about the UK? That's close to home. I think this is an interesting one developing throughout the year, because you've got people, stuck in extremes. The Bank of England and all its cohorts are adamant that they're stuck with sticky inflation, as it were. The services inflation, wage inflation is too high. Dame Deanne Julius was in the press at the weekend. She was one of the founding members of the MPC, saying that they've got absolutely no wriggle room and that there won't be any rate moves till 2025. But the market economists and Bloomberg collating that and having their own view basically said that there should be enough room to move pretty soon, ample space to start easing, and they're anticipating 5.25 starting in May, which puts it more in line with the US start, and hopefully 1.25% off by the end of the year, which I'm really looking forward to, because my mortgage comes up for renewal in November. We need it. And on that note, UK banks have started moving already. The 5-year mortgages are down to 4% for the first time in a while, sub 4% offerings from some. Who would you rather follow? The grey suits that died in the walls, or the actual market participants? I think I know where I am leaning. The only other curveball for the UK markets is they have got a lot of issuance to do as well in the debt markets. Longer maturity bonds, and the DMO, the Debt Management Office, have already hurt that market in the early days of the year, saying that they've got 5 large bond sales coming up, and a 30-year one which affects those longer range mortgage ideas. And you've got the Bank of England lined up to do lots of 20-year raisings, or actually selling off. On top of the bin raisings, the Bank of England is selling off, so you've got a double whammy on supply there. So that's another reason why you think that they might have to be forced to make the interest rate path start coming a little bit earlier, because they're going to have to get the demand support. It's a fine balance, but that might just be, the supply might just be enough to get the Bank of England moving on the rates. So moving into the here and now, what trend changes have we seen so far this year? It was a shortened first week of the year, and a lot of people think it doesn't matter, but there was a lot of impactful data, and you saw my comments on the disco last week. Just to review that, on balance, they were rate positive, which is a market negative. They really lead to the dollar bouncing, a little bit dollar positivity, and we've said that's inverse to the direction. Why? The ISM manufacturing came in, but more or less bang in line. But it was a commentary from their head, Timmy Ferrari, basically saying that things were normalising. There was a bit of goods inflation to come through, so that started people thinking about rates pushing back. Jolts, that was probably the most neutral on the week. Job openings and the people quitting to take better paid jobs, that's sort of dissipating a little bit. Continuing and initial claims, I mentioned it earlier, they are still trending lower, so that suggests that the impact of slowdown is not really coming through. So that's, again, neutral to negative. And then the big boy, the daddy boy on Friday, the NFP, well, instantly, I'd suggested that the consensus was slightly ahead of, the whisper number was slightly ahead of consensus. And that turned out to be true, but the unexpected bit was wages not pulling back, but actually going up. So a double market negative there, and you saw the immediate impact of that. The market then settled down to go into the ISM, and the initial impact was a massive reversal of all that. The services miss was read, and I think it's a misread, as a market positive. And the reason I said at the time, and I'll reiterate here, is that it was the employment component. There's 4 major weights of that piece of data. They all have a 25% weighting. So that employment factor dropping almost 8 points, a quarter of that was almost all the 2 points of the miss. and it was in sectors which I don't think were necessarily going to be hiring in December. This survey, people are encouraged to answer it as soon as possible, but they tend to leave it late. And you're dealing with going into December. Most of these sectors, real estate, people setting up house rentals, retail, transport and warehousing, they will have done their hiring in November. So when you ask the question, is it the same, higher or lower, you're probably going to be saying lower. So I think that was a lower weight positive, and that sets us up for what we've got coming this week. It was, so as I said, that the result of last week really was a pushback on rates, not necessarily long-term material, but things are so extreme, it wouldn't take much. But if you were trading that on Friday, that was pretty tough, wasn't it? All over the place. I mentioned earlier, going from 60% chance of a March cut down to 0, back up to 70% after an ISM. But a lot of the big players don't actually start until the second week of January. They extend their holidays, and the overall driver is the dollar. So there's half a chance we get a consolidation, a little bit of strength, and we're seeing that already at the start of this week today. And the charts are really demanding that we've got this sell-off still to come. So I think we could be setting up here as the start of the big third wave down in this final sell-off, and that could come as early as next Thursday when we've got the CPI. And that brings me neatly on to the weekend. There are really only two events happening, in my opinion, this week. The first of which is John Williams, the Fed governor, speaks on Wednesday night. Now, if you remember back to December, once the 75 bips had been revealed by Powell, the very next day, Williams caught everybody out on CNBC saying that actually, whoa, rein in the horses. We're not saying we're doing it tomorrow, blah, blah, blah. So he will be all over last week's pushback data, I'm pretty sure. So that's another reason for everyone to expect a little bit of caution and strength on the dollar for the week. And then we go into US CPI on Thursday. Well, there is every chance at any moment there could be a little downbeat to the inflation figures. A lot of people said the underlying trend is dying. What you tend to get at times is a big move. When it's only moving 0.1% away from consensus, it's difficult. But as soon as we get something like a 0.5% beat, then this market is going to go nuts. But just be cautious that we've seen wages strength on Friday, and I mentioned it earlier, the dollar weakness feeds through to import prices feeds through from dollar weakness, and that both of those can potentially in the short term appear in an inflation print. So it's all a bit of guesswork at the moment, but the way that the charts are set up, it might just be looking at something nice on Thursday. Outside that, Friday gives us a little bit of activity data from the UK. Not really sure whether we're expecting to see anything good there. And French CPI is the first of the Euro inflation prints. So that's the backdrop for the week, and also the outlook for 2024 and a number of different angles, which I hope you'll find useful. And the whole point of that is to give us some reference points to go backwards and forwards with over the best part of the year. But obviously we need to reference back to the charts. That's something I'm going to do now. I'm very conscious that this style of delivery is quite long, but it's necessary for setting us up. So I'll just probably skim through some of these charts, and I'm going to follow them up with individual postings going forward where we can get into a bit more detail. But one or two of these are quite interesting, and let's crack on with that. Just quickly throw in that oil chart that was in the discussion earlier, because it really does look like a fade the rallies chart for the year. Taking that move down, as we said earlier, from the high to the low. We've had what could be a three-wave consolidation, and we're going to take that as the measure there. So an equal legs, one for one, that we talked about earlier. Starting point is down here at the 30 level. Looks quite extreme. All this geopolitical nonsense. This is a weekly chart, but we'd have to dive in a little bit lower. But you could start selling and using the equal legs of the current consolidation as you kind of stop loss. So around, it's already had a 0.618 consolidation. So this could easily be the start of the next down leg. But 77, 75 up here, that would be the equal legs of that move. If we're getting up there, it's time to get interested. So here we have what I've been waffling on about quite a bit, the DXY, the dollar index. Look, referencing the 2008 low. I know this is a monthly chart, but it's useful for showing you the overall move. We had the real expansion between 2011 to the market's low in October 22, the indices low. And since then, we were tracing out this consolidation pattern. From what we said earlier, we're looking for a equal leg, so the A leg to equal the C leg, and that is kind of suggesting a 92-ish, 93 low. Because these moves here are slightly impulsive, it looks like we've had a 1, and we're currently in a consolidation 2 before we get the big move, doing most of the hard work left in this consolidation to come. And it's probably more instructive to look at the lower time frames. So we'll drop into the 1 hour. And as you can see, if that 1 low was put in there at the end of December, we are seemingly tracing out a zigzag. Why is it a zigzag? Because we've had a 1, 2, 3, 4, 5 move wave up in a consolidation. That suggests you get a little 3-wave consolidation and then another 5. I said on Friday we're taking things at trust here, and this reminds you of the setup for the indices with the bulls who took the COVID sell-off in 5 weeks. You can get these 3-wave moves in very short time frames to be significant. So let's hope that Friday's was. We're in a little bit of consolidation here. It feels like there's a break coming. Maybe this is the big boys back at work and interpreting it the same way. Nervous going into, I've labelled it up there for around Thursday, looking at an A equals C reference point. Let's see how that pans out. And we might as well just throw in the euro dollar discussion while we're here on the dollar. If you remember last time we updated, we'd had this breakdown in the dollar indices on the week data. And at that point, it was unconfirmed by the euro. We've since had that confirmation sorted out. And we now seem to be back on track, very much on the same trend. You take your pick. There's a lot of these setups at the moment because they're inverse to the dollar. They're all the same chart. So, trade what you're comfortable for the same idea, really. Right. I'm conscious of the time that we're going through here. And I'm going to leave indices for a different update because I think gold at the moment is really interesting at all sorts of time frames, and there's some real qualities to look at here. So starting off in the 15-minute zone, I've been having a double set of Bollinger Bands attached to these because commodities do tend to be a real mean reverting instrument. So I've got the outer ones are 2 standard deviations and the inner ones are 1 standard deviation away from the yellow mean. So in simple terms, what does this all mean? Well, it's based around statistics, probability, what they call the normal curve. You might have done it at maths. You might have just gone to sleep. The middle line, that's on average from all the data that's collected. And then you've got the 1 standard deviations. That means that in this block here, 68% of the time, the thing's going to trade. You put in a 2 standard deviation because then that covers 95%. And then people say, well, why don't you go to 3 standard deviations, which means 99% of all the data? Well, the problem is, particularly in financial markets, once you start getting out to the 99% realm, there's normally a reason for it, and taking that on and expecting it to reverse the other way is probably wrong. You'll find numerous examples of it. You're either shorting a takeover or you're buying something that's going bust. So not for, unreasonable reasons, we stick to using 2 standard deviations at the moment. So the premise is a lot of people use this, and it's halfway there, but not the full way. Once you break outside the 2 standard deviations, you're expecting the next time it comes back in, and generally will cross to the other side, and you're trying to capture that. But what happens, and particularly in commodities, you'll get what they call walked up. So look at this instance. It did, in fact, break out the range. It came back in. We're at 15-minute interval here. It's very volatile. This was Friday, obviously, but right here where you've got 3 opportunities of selling this thing, expect it to come back, and you've been absolutely wiped out if you're not using stop losses properly because it's continued to go. So this is a reason to have the 2 channels in there, because what we want to really do is trade it when it's in its extreme zone, which is between the 2 and 1 standard deviations. And then as a general rule of thumb, once you start seeing the body trading below the 1 standard deviation, once about 75%, and you work out for your own feelings, but generally 75% was the rule of thumb, appears below, then that's the end of the trend and you should be out. Again, once you feel like it's going back in. So a lot of this is dead man's land. You can predict it using other ideas, but generally for this premise, you leave it alone. And then once the bands become closer, that's what they call a lack of volatility. Volatility has gone so low that you're expecting a big move either way. We can set this up from looking at the waves, or if you just stick into the Bollinger Band trading, once it goes, the body goes back in, you're looking to stay with that trend until 75% goes out again. So again, here, a number of examples of it breaking outside. And if you went into to buy that back expecting the trend thing, you're going to get serially walked down. And at no point here is 75% of the band of the bell of the candle gone into that zone. Here, you've had a full body and you should be out. Again, you come back in. That hasn't probably broken it. That's not 75%. So you would have managed. And even if you came out here, you've got another opportunity to potentially get back in if you're watching and capture that with tight stop losses. So that has been happening time and time again lately, in particularly in the European trading session. It's something to watch out for, and well, it's a very good indicator to follow. So I hope you found that short-term analysis interesting. But what I really want to look at is a slightly longer time frame here, because I think it's very instructive how we've got so much volatility and it's all valid until certain parameters are met. So remember, we've talked about this long-term gold chart before with a major low in the 2000 crash. We've got the 2011 breakout top, which was deemed to be an impulsive third wave, and then really the start of 2015. So late 2015, early 2016 was deemed to be the last major low, which was a fourth wave of whatever degree cycle at the longest level you're comfortable working at. So we've had four waves. We're looking for a fifth wave, and most people agree that we've had four significant waves to the upside. So we're in a fifth wave, looking to make a new all-time high. Now, anyone that's watching closely and or knows notation for Elliott wave will see that that isn't the same five as what you might be expecting if that's the end of the move. So that's labelled up as a five, a one of the next level down, the lower degree. Because it's a commodity, they tend to do all their extending in the fifth wave. Plus, we're in an environment where we're coming off all this high inflation. There's massive chances of breakout. We're in a start of a super cycle, which we discussed earlier. Supply shortages with demand. There's a very good chance that we're into not only a short-term new time high, but for the next decade, there could be significant strength. But what do we know from wave theory? We've talked about once we've got five significant waves in and we've got a one in place, we are going to have a two wave come in there, which is going to be a three, isn't it? It's going to be a one down, a consolidation of the one down. What's quite interesting here is, particularly for people who rely on the gold price, is that we've been stuck in this kind of 1,000, 2,000 range, and then 1,600, 2,000. What should happen now is that 1,600 becomes a base to higher prices, so the long-term average for those markets is higher. That is quite important, and the fact that the fourth wave, and pretty consensual fourth wave, is here at 1,600. That's normally a good stopping place for the next consolidation wave. It stops around the fourth of a previous degree, a lower degree. So this area, very important for consolidation. And, even though these are real extremes relative to the moves we've had, it gives people confidence to invest in the gold sector, which again feeds into demand. It all becomes a little bit self-fulfilling. But this all started to get interesting because the shape of the fifth wave is creating all sorts of outcomes, and you yourselves are probably seeing this extreme volatility and can't understand what on earth is going on. It's madness. So we need to delve into what the different valid setups currently are. And let's go for the most bullish to start with. So the most bullish is the fact that we might actually be nesting, that we've made a one, so it's like a five wave up to give us that first 2080 foray that we had. Then we subsequently had a three wave pullback. And then we had that breakout again in late December. We had again another test of that triple top, and then we finally took it out and we put in that extreme high point on the early morning of December the 4th, which didn't hold at all, and that's what's caused all the trouble. So we've had potentially a deep pullback for a second wave, and now we're again in this nesting. So we'll have gone 1, 2, 1, 2, potentially again 1, 2, and then you're eventually building up for an explosive third wave. It's always, and if you're getting a third of a third of a third wave, then you can imagine how bullish people are, and that is the most extreme, and that's highly likely to take us to real extremes for the move, probably 24, 2500, but more of that at a later date. And what this bullish chart also introduces is a key level, the sort of 1973 level, the pullback of what is labelled up as the 2 at the moment. That can't break unless this whole structure becomes invalid. So that is the key support level, and we're seemingly moving towards it in the near term. We're currently trading at 2021, but that doesn't preclude the fact that it can go lower and is set up on the bearish structures to do that. And we'll have a look at what those look like right now. So we previously looked at this chart before Christmas, where I said the guys who are looking for this leading diagonal idea to put in the 5 waves, there was a series of 3. So you can, even though you're looking for 5s and 3s and 5s and 3s generally for an impulse, you can have the diagonal where it's a set of 3s. So it could be 1, 2, 3, a 1, 2, 3 pullback, a 1, 2, 3 up to that breakout high that we subsequently come off at. And now, again, we've got this sort of 73 low here that we're dealing with. We've had the bounce off. Now, if we're looking for this to make a 3 wave, what's our first instance? It's equal legs, isn't it? So 1 down from there, putting in currently against what has been the rally high around 2090. Then equal legs is suggesting something down here around 1910, 1915. Now, I've drawn a few instructive lines in before. So going from that low through a wave 2 low gives us a sort of trend across. Equally, you can have the trend channel. We've got a 1 and a 3 in place. So drawing that through the 2, that gives us the widest berth there of possible outcomes. And then also from the low, I've drawn in a line which would suggest a 0.618% pullback of that whole wave 3. So when you've got leading diagonals, waves 2 and 4 tend towards a 0.618 retracement. We know that's an important Fibonacci number. So on the basis that the first one did almost hit the 0.618 retracement, the green line here, they would expect this one to do the same. So the orange zone is what we're heading for, if that structure is correct. And so far, there is this one has probably been the most accurate, so we can't rule it out. So that means if that comes to fruition, 1910 level is where, and around that 0.618, 1939 to 1910 to 1940, we should really be looking to get the buying boots on, because then we're looking at a 3-wave move up. We'd probably expect it to meet that channel, if not just break out the channel before it comes back, and that is a new proper all-time high at 2200 plus. So that setup looks as though it's valid for the moment. So last but not least, this is the setups which often infuriate a lot of non-cohorts, non-believers in Elliott Wave, because as I said previously, you've got to have alternative views. If it was all the same and easy to read, then there wouldn't be any point, would there? There'd be no analysis. So we've got the best guess, but because we've had a 1, people agreed it's a proper top. You're going to have a consolidation, which is a 1, 2, 3, but equally that can extend. So you can have a 1, 2, 3. We have a consolidator, a connector, and then we get a final leg. The only problem with this is because of the extremity of that December the 4th move, which went to a new high, it is valid. It's called an expanded flat, but historically they don't exist that often in the thing. But more and more that I'm reading of late, you see more and more people label them up. And I was chatting to a quite respected chartist recently, and he said the expanded flat is valid, but it's got to be the last resort. It's the lazy way of trying to explain something when it's done what you haven't done. You're trying to still fit your narrative, despite it not being the best idea. So we'll allow for it, and it is actually the most bearish, because what happens, you've got an expanded flat, you have the one move down, the A move down, the B move up, and that's gone to a new extreme, and then it has to finish beyond that first impulse down there. So that would take us back below 1800. So it's still valid, and a lot of people are calling for that to happen out there, but I'm still having it there as the least likely thing to happen. What you've got to remember is it's not ultimately bearish. It's just putting in the low for the second wave, and then we're off to races again, which would mean ultimately a proper 3 wave that would be bigger than the one previously, again, taking you to all-time highs and leaving a 4 and 5 still to come. So, it's making it more and more volatile, but more and more likely we get higher highs. So that's quite instructive from Elliott Wave. But I think what the takeaway from this is, we're either bullish until we break 1973, or equal legs down to 1920 are the most likely. And the sort of this week's going to be interesting, because it might just be putting in an extension to the connector. It might not be a new break, and that impending dollar strength that's ahead might actually take us down here. So we might not get the ultimate new all-time highs in gold in the first quarter. They are coming, but be aware that there's a lot of potential negative that we've got to work through in the first instance. So when I say you've got to use stops and capital allocation correctly, or you've got to be watching this like a hawk, gold is infinitely going to be rewarding both ways, but you've got to get the stop losses right. So that's the end of that. I hope you enjoyed it. Remember, I'm analysing the markets. I'm not advising, but I'm available for questions, anything that's arisen from this. If you made it through, look at it as something you can dip in and out of. It's not something you necessarily have to sit all the way through. As I said earlier, I'll break this down, and we'll give more analysis in smaller chunks, as well as the longer updates on occasion. So be careful out there with your trading, and we'll speak soon. Cheers.